All right, here we are. We're just a few minutes late, but I'm really excited to start our new Start Engine initial coin opinions. Anyway, we got today Marc.Boiron, who is a tremendously talented lawyer who's going to be talking to us about some really exciting stuff. And we have a nice surprise at the end today where we're going to talk about how the SEC is going to be joining the comedy club. And I think this is such an interesting time for everybody that today we're going to discuss really a new area of ICOs, which is the music area. Anyway, Initial Coin Opinions is every week. We're now also turning it into a podcast, and we're going to publish that. You'll get an email. You can send your questions, no problem. Just type it in we're in YouTube now, which is a big upgrade to our system. Type it in, and then Marc and I will answer your questions. Anyway, let's get started. We have Marc.Boiron. He's a partner now of FisherBroyles, and he's with us today. Welcome, Marc. How are you doing?
I'm doing well. How are you, Howard? Thanks for having me.
Well, Marc is one of those attorneys who have embraced the Jobs Act. He was there very early when it started, and he is now not only an expert in the Jobs Act, but he's also an expert now in crypto, blockchain, initial coin offerings. He is one of the, I would say, the leaders here in Los Angeles and Greater Los Angeles. And he has a lot of clients we actually work with, and it's been a pleasure to work with him. So he represents now in his new firm the blockchain side, and especially in the entertainment side. So he's going to be telling us about how that area is growing very fast. Prior to being at FisherBroyles, Marc was at Rutan and Tucker LLP, which is another law firm, very, very good law firm. So if you've attended the Startengine ICO 2.0 Summit, you'll recognize Marc because he was a speaker and he talked about airdrops, which is still very controversial. Anyway, Marc, thanks for joining us. We're going to start right now. Just submit your questions. Don't forget, this is live. This is the benefit of being live. So before we jump into this episode, I want to take a moment to remind people that we are hosting our first live demo day. It's called Demo Dive on May 31st. You can join. We're going to put a link here in the YouTube so you can see how you can join. That's the easiest way to do. All right. So we're going to talk about the blockchain in music. I'm excited about that because I kind of delved into music when I was in the video game area. So I'm really excited to hear from Marc what he has to say about it. So for the first question, Marc, is how do you see blockchain technology being used in the music industry?
Yeah, sure. So I think there's kind of two key ways in which you see it playing out. I think the way that everybody thinks of it is because blockchain technology is so good in terms of recording transactions in a
Okay, so Marc just, again, this is a live episode. Marc just signed off. I don't know. We'll try and get him back. Just let's go move on to until Marc comes back to the Howey coins, which was something that I think surprised the entire industry. So here's what happened. The SEC last night, or actually yesterday, sent a press release that there's a new ICO called Howey coins. Now, for those who may not know, the Howey test has been used for the last 70 years by the SEC to determine what an investment contract looks like, what a security. And a lot of people have been talking about the Howey test. A lot of people are using it all in different ways and interpretations. But in the end of the day, it is one test that the SEC may be using to decide if what you're issuing is actually a security or not. And it turns out that after all the bulletins that the SEC has been issuing and all of the notices, most companies, lawyers, promoters have taken a long time to digest it. And you still see today a lot of ICOs that are utility-based token issuances, which are in a way not compliant with security laws. And so the SEC, in their entire frustration and ongoing anxiety, trying to avoid a systemic risk to investors, they decided to come up with a new website called the howeycoins.com. It is hilarious. And basically what it is, it's a real ICO looking website where you have the pitch, you have the white paper. There's actually a real white paper that's fake, of course. You got the advisors. You even have celebrities who are fake celebrities. And you can actually type in your email address to get more information and say you want to invest. And the next thing you do is what happens is it appears a SEC, real SEC website that is describing how this entire page that you just saw was a complete scam. So I had a lot of fun doing it this morning. I recommend you do it, howeycoins.com. And the other thing is,
Howard, it's Mark. So it sounds like I might have dropped off for a second. So apologies for that.
Okay, good.
But we can go back to the music industry. But being on the Howey Coins, website point, it's really interesting. I think one interesting thing that the SEC would have never done, but would have been interesting to see, is how many people would have actually sent some kind of digital currency to a wallet if the SEC had set it up. They might be funding a lot of operations that way.
Perfect. So you know what I would have done? I would have sent some Bitcoin fractions, because this would be such a hilarious thing to see what they do when they receive the money. And as being a federal agency, I guess all of that money is put in Treasury hands, right? They can't hold the money, right? Is that correct?
Yeah, I assume they can't. I assume they can. But look, I think I think this is, a lot of people are seeing this website as a joke. I actually think it shows a lot about what the SEC is doing and how much they're thinking about the area. I mean, it was thoughtfully done. And clearly what the SEC is trying to do is kind of think creatively about how to deal with the area. And I think they've successfully done that with this website. And I'm guessing there's probably a few people who won't be scammed because of it. So it's a really interesting play, but I think it actually is serious. And I actually think the SEC showing their competence, notwithstanding what many people might think about them in this area.
Correct. And what I find amusing about it is that it is a joke, but it's actually presented as something real. And I think the bulletins they've been issuing have been read, but not really followed. Still a lot of companies who are not following the rules. I think really what has made the most attention, frankly, has been the enforcement. Have you been seeing the enforcement side with the work you're doing?
Yeah, fortunately, maybe we could say it's because I'm good counsel. I don't know, or I have really good clients who listen well. But fortunately, none of my clients have actually been subpoenaed or received phone calls from the SEC. But I think that just goes to recognizing that I think 6 months ago there's a lot of people in the space who are maybe a little bit behind the 8 ball in terms of relative to the SEC. And if you're kind of looking forwards and listening to what the SEC's been signaling for a while, it's not surprising where we are now. And I think there was a way to keep clients out of trouble in a way that they could still successfully raise capital. For what it's worth, I think the turning point was that Munchie cease and desist order, right? That I'm sure has been talked about. Well, it has been talked about a lot, but to me, that was that warning shot that the SEC gave, being like, here's your fair warning. Before that, maybe things were confusing. Now things are not confusing anymore. And, then you saw them move swiftly with their subpoenas, phone calls to folks. And now, I think they did throw cold water on the U.S. market. It's hard to raise money in the utility token market nowadays in the U.S. And I think that is the SEC achieving its goal. And now it's saying, okay, we've cooled things down. How can we think a little more proactively about the space? And that's where you see Howey Coins come out.
So let me ask you a question. I did the Howey Coins this morning, and then I put my email address and I clicked submit, and I see this beautiful website from the SEC, which is now saying this is actually a fraud, and here's why. One thing that struck me interesting was that he talked about the so-called exchanges. They said, "Hey, hold on a second. Those exchanges that portray saying that you're going to be trading your coins are not registered." Are they sending a signal right now that they're about to shut down all of the so-called exchanges like Kraken and Shapeshifter?
Yeah, I mean, look, I think on that point, and where most of the exchanges stand relative to them. So I think on that point, the big question is going to be not if, but when the SEC is going to take action against the exchanges. On top of that, I think it's pretty clear that I think there's even a report that Kraken is looking at getting registered with the SEC. And so, I think the exchanges see the writing on the wall. Most of them having international setups probably think that they're outside of the SEC's reach.
Yeah, but hold on a second. Kraken, I just was hearing the CEO, Jesse, who was talking about it yesterday at the Consensus Summit. He said he's refusing to reply to the New York Attorney General's inquiry. What do you think about that?
Yeah, so I remember reading that I can't remember. I think it was a couple weeks ago. I think the position that they're taking is that, look, we intentionally moved outside of New York and stopped operating in New York because of the bit license, and us not wanting to get one. And so now that we're not in New York, you really don't have a right for us to be asking for you to be asking us any information. Now, my view on it, and I've just kind of always been on this, is sure, you need to be careful in terms of what you disclose, but typically, it's not, they're going to want to operate in New York in the future. And so working with the regulators in New York in a way that makes it clear, hey, we don't think that we're actually subject to your jurisdiction, but we care when we respect New York because we operate very closely, that you're requesting, let's work together. It seems like that would be a more constructive approach than to say, hey, we're just not going to do anything with you, and we're not going to respond to you.
I mean, I'm sure they have tons of lawyers at the company, but I can't imagine how their counsel is saying, hey, you know what? Publicly defy the New York Attorney General's request and do a public statement about saying that they're not going to join in is actually, I think, pretty aggressive. I mean, I'm not sure that that seems like a prudent way to do it.
Yeah, and Howard, it looks like I may have cut out again. Sorry about that. I think the approach that seemed to be more reasonable is to say, look, we don't necessarily think we're subject to New York's jurisdiction. We stepped out of New York for a reason, but nonetheless, we are going to work with you because New York is an important jurisdiction for us to operate in down the road. And so we're going to show some good faith and work with you.
Great. Well, you know what? I wish they hired you as their attorney because I really like how you think, and you certainly are very competent. I mean, you always hear the SEC saying, get a great securities attorney. I mean, that's always one of their statements. And you know what? Love it, because someone like you could certainly help these companies navigate these, I would say, regulatory requirements. Now, let's go back to the music side. And you were going to explain to us how the blockchain and music industry are evolving right now.
Yeah, so as I think I started saying earlier, is there's really the two big ways in which the music industry is going to embrace. All revolves around the sharing of royalties. Whenever you single piece of art that an artist puts together, there's several players in that. And when you take just the typical streaming service, the thousands, if not tens of thousands of payments that need to be made, everybody, let's call it the music industry supply chain, is enormous. And it's about being able to instead automate all of that through smart contracts, move it onto a ledger that can then be verified by everybody. I think it's a big evolution in the industry. And I think it's probably one of the most natural uses of blockchain technology. And it's very similar to one that I'm sure you appreciate, Howard, but in the video game industry, just really all coming down to digital rights management, as well as sharing of royalties. And that brings us kind of to a second point, which is, being able to connect artists directly to their fans. That's another way in which you see blockchain technology really evolving. And I think those two things, the platforms that might win out in the blockchain music industry, is really the ones that combine the two. Really connecting the artists with the fans, and at the same time, creating a mechanism for tracking and paying out all the royalties in an automated way.
But in a way, you just alluded to video games. I mean, you probably know about CryptoKitties and how they're using Ethereum as a way to create smart contracts that protect each individual digital entity, which little cat, that has a different DNA than someone else, and some of them are more valuable than anyone. They're using this standard called ERC 721. Is that what you're seeing the music industry moving towards?
Yeah, I mean, I think that's something that let's put it this way. I think once we get over the ICO craze, there might be a little bit more focus on that. But for the time being, I think there might be a way to use it. But if you take a song is really fungible, and an ERC20 token is fungible. And so tracking the use of that song through an ERC, or the downloads of that song through an ERC20 token makes a lot of sense. I'm sure there are plays in the music industry for an ERC 721 token, but I think the focus right now is getting us to a point where blockchain technology is actually used in the music industry rather than just talking about it being used in the music industry.
Right, but today the music industry is highly centralized. You have organizations like ASCAP, which is a society of composers, and then you have all of the big publishing entities like BMI, Warner Music. It seems like extremely centralized, and these stakeholders are not going away so easily, in my opinion. So how do you see those blockchain decentralized applications actually becoming successful and displacing this antiquated system?
Yeah, I mean, I think it comes down to maybe my thesis on the blockchain space in general, which is the question is not centralized or decentralized. The question is the rate of decentralization. So you go from centralization towards decentralization. My view is the companies that are trying to build blockchain-based solutions in the music industry that want to immediately cut out all labels aren't going to go very far. You've seen that even before the blockchain craze. You saw people trying to go directly from artists to musicians and to users, and that works somewhat. But the labels are big players. And so you're not going to see them go away. The more likely thing you're going to see is labels understanding the risk of decentralization to them, and trying to work the decentralization and blockchain within their ecosystem. And so that might very well be companies that are reaching out to those labels and trying to see how we can work together to build something that everybody benefits from.
I mean, last time the music industry felt a shock of technology displacement, it was when Napster came out, and with the early internet, this whole peer-to-peer network system completely destroyed them. I mean, the amount of royalties artists were earning were going down, and then they had to resort into touring because that was making money. I mean, is the blockchain going to put a nail in the coffin for these people, or is it actually going to do the opposite? It's going to actually bring them back their riches? I think we've lost Mark one more time. So there's a question that I'm going to answer from one of our listeners. So Tantra Punk, that's an interesting name, has a question, which is, how plausible would it be to lobby for competency tests that, if passed, would give ICO retail investors the ability to waive the rights to be protected by the SEC's personal wealth income exclusion? So what Tantra is talking about is this idea that if you do a Regulation D 506D, which means you have a public solicitation to investors, it's for only accredited investors. Now, what is that? An accredited investor is someone who makes over $200,000 per year as a single person, or as a couple 300,000 a year, and have or has $1 million more in value outside of their home. I mean, you're talking about 5% of the marketplace, maybe less. And it seems completely unfair that just the rich can invest in these really interesting opportunities. So the idea that you can waive this and transform a Reg D into a product that the consumers can invest in seems not going to happen anytime soon. However, great news, Tantra, great news is that you have regulation crowdfunding, which was instituted in May 16th, 2 years ago, actually, in 2016, and allows companies to raise up to $1 million from the general crowd, from everybody. And it's very easy to put in place. We've done over 100 of them at Startengine. We're now launching 20 to 30 a month, soon 50 a month. So we know it works. The other way is to use Regulation A+, where you can raise up to $50 million a year directly from the consumer. So really, Tantra, in a way, you really don't need anything more. Everything that is needed has been already given to us by the SEC in the Jobs Act, which is called Regulation Crowdfunding, which is also Title III of the Jobs Act, and Regulation A+, which is Title IV of the Jobs Act.
Anyway. And Howard, and sorry, I obviously went
go ahead, Marc.
Off, but on the Reg A+ front, it's interesting in this space. One thing that I've had difficulty dealing with clients, and I understand it, is this industry is moving so fast, and from a competitive perspective, waiting 7-8 months and still not necessarily having an answer to whether any ICO is going to be approved, qualified under Reg A+. It's really hard to tell clients, hey, let's go ahead and launch a Reg A+ offering. Reg CF is a whole different story, and it's a great tool to do that. I think that the SEC could really help the industry move towards using Reg A+, which I think is the future of the industry. If only they could kind of get these qualified and start showing that things can move a little bit quicker than that, and that they will actually be qualified.
I totally agree. And when we were doing Reg A+ prior to the ICO, the response rate was very simple. You file, 30 days later, you get a response, pretty much on the money. And then they promise, I think, a 10 or 15-day response on the comments that they make. So when you respond to their comments, they come back to you. So the back and forth happens, and within a couple more months or less, you're qualified. And right now, we have clients who are exactly in a situation you mentioned, Marc, where they're waiting for a response from the SEC. And I have to imagine that the SEC, given their view of ICOs, is they're being very cautious and careful. Now, what do you think from your experience, Marc? How long is this going to last until they're going to say, okay, we're ready to go?
Yeah, it's hard to identify what is taking so long. Part of the reason for that is, if you look at the companies that have actually filed Form 1As, a lot of them, I think maybe even most of them, are relatively simple. In that, I always say, if you want to do a ICO where you're tokenizing equity, it is simple. It is very simple in that it is just a securities offering, just like any other. You happen to be issuing shares that are then going to be represented on a stock ledger that is on the blockchain. It's not that complex. And so that's the biggest difficulty is why the SEC has struggled so much with companies. And I think one of them is yours, probably one of the first ones, Gab AI, for example, why it is that Gab, when it's really got a great simple structure shouldn't be qualified is difficult. And I think it just shows the difficulty that the SEC has dealing with the industry as a whole, the signals that they may be making once they do qualify one, and making sure that nobody is viewing the qualification of one conservative ICO as being the standard, and the SEC kind of lessening its standards, I guess, in the ICO space.
But you're talking about a simple equity offering, which they've done thousands and thousands at the SEC. And usually a company will issue a stock certificate, which is a beautiful piece of paper with a nice seal on it and a signature from the CEO. And investors don't receive these anymore because most of it is called book entry, which means it's online and digital. And now, so instead of this beautiful stock certificate, you get a token in a smart contract. Why should that be a big deal?
Yeah, and I think the answer is, if the first thing that came to life in the ICO world was tokenized equity, I don't think this would be a big deal. You see some of the questions that the SEC asks, or some of the comments that they make, which are general things like, give us your view on whether Bitcoin and Ether are securities. And clearly they're using the Reg A Plus platform as a way of exploring the ICO industry further. I don't think that would be happening if tokenized equity was the first thing that came to life in the ICO world.
Yeah, I think I agree with you with that point. I'm trying to tell the SEC when we have interactions with them, and usually through our attorneys, of course, is that in a way a tokenized equity is just equity, and the token is purely a virtual representation of it. It is not the equity. The equity is inside the certificate of incorporation of the company. It's a contract between the investor who signed a purchase agreement and the transfer agent so happens is holding the records. So why would it be a big deal if you have a way, instead of sending someone a stock certificate, just give them a smart contract? We're in 2018 today. Why stock certificates were happening in the early century, in the 1900s? I don't understand.
Yeah, and really, when I think about it, if there is one reason the SEC should be concerned, it's that in today's environment, if right now a Reg A Plus offering is qualified, and shares will be immediately tradable, and they're represented by ERC20 tokens, those ERC20 tokens within seconds can show up on decentralized exchanges, and very quickly after that could very well be, without the issuer being involved whatsoever, showing up on centralized unregulated exchanges. And so one interesting point will be, maybe the SEC is waiting for things like T0 and Templum to be live, at which point, for example, T0, knowing how it works a private ledger, and companies will be able to simply, if they wanted to, lock their tokens within that private ledger and not let it off. If that's the case, then there really are no more concerns. But I could understand the SEC being concerned about the fact that you're going to have equity trading on unregulated exchanges.
Well, here's my point: is an ERC20 is just a little standard, so a bunch of functions inside of a smart contract. Our view is you just put a little blockage in there that says that the transfer agent has to agree to the transfer, meaning the transfer agent was instructed by a regulated alternative trading system broker dealer saying, hey, this trade happened, it's good, it's been registered with the transfer agent. I mean, recorded, not registered. They don't like, SEC doesn't like to hear these words, registered or listed, or, okay, it's been recorded by the transfer agent. And now when the ERC20 contract says, hey, I want to transfer from Joe to Mary, looks and says to the transfer agent, which is a registered transfer agent with the SEC, which is pretty cool, yes or no. And if it's no, nothing happens. What do you think about that?
Yeah, no, I think that works, and that goes to the point we were talking about earlier, which is moving from centralization to decentralization. Most purists are not going to like the idea of a transfer agent needing to approve a transfer. But in reality, in the short term, that's more likely the answer that we need, which is, hey, rather than having it completely decentralized, let's move a little bit away from that. But we'll have some centralization. With time, technology is going to be where it needs to be so that we can track everything, and the law might catch up a little bit as well if it needs to. And we're going to be in a point where maybe it can be decentralized completely. But right now, that's not where we're at.
Well, the Ethereum was built with the concept that there's a trusted source inside of the smart contract, because I think the founders of Ethereum realized if you just do everything decentralized, because not everything can be decentralized, it's going to be like Bitcoin. It's going to just be a one kind of trick pony. But by allowing a trusted source inside of a smart contract like ERC20 style, you're opening up to tens of thousands of applications, including the idea that a transfer agent is a trusted source, because the data that the transfer agent has is basically very private. What's not private, or should not be private probably, is the fact that a company has issued shares and has a lot of shareholders. I mean, that's what people do, is register with the SEC, which is public information. So in a way, my view is very simple, is look, you need a trusted source today, and maybe you won't in the future if the laws change, but you need a trusted source where it contains all of the information of the shareholders. And if there's a trade, there's a trace, there's a record, and if there's fraud involved, then the justice system will work.
Yep, can't disagree with you there.
All right, going back to the music industry. I mean, I personally, I'm not an expert in music industry, except for when it was music for video games, and I've done a lot of work with that. You have clients. I mean, you're in LA or the greater LA, and you have the entire music industry here at your footstep. How much are they interested in the blockchain? How much are they interested in what you're doing for this industry?
Yeah, so I think it obviously depends who you're looking at. We talked about the labels a little bit, and I think it'd be hard to say the labels are embracing it, but they recognize that it's coming. I think on the user side, without a doubt, they're by far the furthest ahead in terms of wanting kind of adoption of blockchain in this space. That being said, I wouldn't say that's mainstream users yet. That's still going to come with time. The most interesting one is the artists themselves, and it's like everybody. You've got different risk tolerances, and you've got some artists that are actually very open to it. But I'd say most of them have felt that they've been burned by the music industry, by changes in the music industry. So you referred to it earlier. Obviously the change from physical to digital music, and the impact that had on artists, and it was a very, very negative impact. And so I think artists are a little bit afraid of a similar impact. But really, what this is going to do, it actually creates an opportunity to reverse what happened at that time and give the power back to the artists. And I think with time, the artists are gonna kind of realize that and are gonna come on board. But the labels will always be the kind of big gorilla, at least in the next few years.
I mean, look, the artists always feel they're being screwed. Even when there was no internet, they were accusing the labels of screwing them. There's a lot of famous cases where artists didn't get paid their due share of royalties from the labels, and a lot of fighting going on. And then they have these organizations like ASCAP that was trying to protect them. But then there's a lot of music productions or licensing of music that was done without payment of royalties. I mean, it was a mess before, and now it's a bigger mess. How is blockchain going to clean up this whole thing?
Yeah, I mean, it's interesting. I mean, I think the being able to connect artists directly to users in a way that hasn't been done before, is probably the solution. I think one of the most interesting questions in that is what role will cryptocurrency play in that? And how important or not important is it to have a cryptocurrency to enable a decentralized system for artists and users? And I think the answer is that currently what is being contemplated by many is something that really doesn't work in the current regulatory environment, which is that a lot of companies are having difficulty creating an ecosystem that lives within itself. Right. So the concept that you have a cryptocurrency, and you see this all the time in the world of ICOs, but the concept that you have a cryptocurrency that the only way that you can monetize it as an artist is to go to an exchange and sell it to somebody else who views it as an investment, is a difficult thing to live with, because if you try, suddenly very difficult, you start having difficulties transferring it within that ecosystem, which is why I know Startengine's done a lot of work in this space, especially with its rate agreement, is why dual token structures become necessary. And that's something that I've actually seen probably more in the music industry than any others, because of the importance of having a free flowing token.
Yeah, I will agree with you that this idea that you have a token on a blockchain that is being used as a speculation means it's a security. It's listed on exchanges, it's limited in its availability, and now it's a security. And now it has to operate on an application. It's unwieldy because every time you go in and take that token to use it in the blockchain, you have to do a anti-money laundering review, know your customer. I mean, it's unwieldy. It's like showing up in a Starbucks with a stock certificate to buy a cappuccino. I mean, how do you avoid that?
Yeah, I mean, and I think that's where you see those dual token structures. So the concept there, for those not familiar with it, is that you're gonna have a security. Security looks like could be very different, right? It could be equity. I mean, technically, it could be some form of debt. It could be a revenue share. It could be profit share. There's a whole host of things that even outside of your typical equity-like concepts you could build into it. I've had clients who have said, "Hey, why don't we create a separate blockchain and our security tokens are going to mine tokens?" So there's a host of things that you could do. But then the concept is you have a second token, and that second token is the one that's going to facilitate transactions on the blockchain, and is going to let the company take advantage of the blockchain. So now you're kind of killing two birds with one stone, which is you're raising capital by selling the security, and now you're implementing blockchain technology into your company for the use of your token and presumably additional platform development.
Yeah, and I agree with you. I think this idea that the second token could be a utility. Why not? It's just being used for the application. Seems very logical. In fact, at Startengine, we came up with this rate concept, the real agreement for tokens and equity, which is exactly the same concept. Two tokens, sell equity, sell debt, sell revenue share, sell something that has full governance and rules behind it, and then sell this offer as a perk to the investors if and when this token is available, if and when, and they can use it for their own music purposes if they want. I think that seems like today, at least today, a fair compromise, because I'm always worried when I hear the idea that people are issuing security tokens only as a blockchain application. It's unwieldy. I mean, you're not going to be able to use it. And every time you want to use it, you have to go through all sorts of requirements, which, by the way, includes probably broker dealers in the mix. It's just going to be too hard.
Yeah, and Howard, you said in something interesting. I think it was a careful choice of words on your part, which is that second token could be a utility token. And I think there's an assumption by many in the industry that you can go ahead and sell a security token and then the token, and that's always going to be considered a utility token. And that's probably not right? The SEC is probably going to attribute some value from the purchase of the security token to that utility token. And so actually structuring that second token in a way that lets you actually have a utility token rather than a security is important, because it's not just going to happen just by the fact that you have two tokens in your structure.
Right. So the second one, I always hear companies about the second token and talking about it, and My view is a little bit of what you just said is, look, if you're going to list it on exchanges like Bittrex and Kraken and Shapeshifter, you know what, frankly, that's going to become a security. So how about this? Sell your equity, take the money, build your blockchain application, make a great job. And then when it's ready, your blockchain application is actually working and you need a token to operate it, then shower those tokens to your investors to thank them for being there early on. Don't list them on exchanges. Don't make an attempt to do it, and build a great business. What's wrong with that?
That's exactly right. It's one of the biggest things that I push is we need to start thinking. I think you're seeing it more and more, but we need to start thinking about how to really build a business out of it, and that comes to the core concept of whether to even do an ICO at all. And it's different when you do a security token, ICO, where I think you have a I think there's a purpose beyond the utility to do that. But I think when it comes on the utility side, regardless of whether you're going to do an STO as well, I think you really need to think about whether it makes sense for the business. And I think having the STO is going to help that, because now we're not going to have utility tokens or purported utility tokens exist just to exist, because really what was intended was to raise capital. But now we have a mechanism of saying, okay, let's raise capital through an STO, but then let's look at whether we actually really need these utility tokens to make kind of the blockchain ecosystem better. And maybe we can just build a blockchain network that doesn't need a cryptocurrency, and all we're going to have is our token that was sold in an STO. And things could really be simplified that way if everyone didn't look at the need for having a token.
It's interesting. You're using the word STO, which is securities token offering, as opposed to ICO, initial coin offering. What, just personally for yourself, what do you think is going to be the right terminology? Is it going to be ICO or STO or just intermixed?
Yes. So, I would say, personally, to me, ICO, that language, I use it because everyone's accustomed to it. To me, it's been dead for 6 months. It's language that if you used anywhere, in any kind of legal documents, it probably wasn't the best choice. And you kind of slowly saw an evolution, right? You saw ICOs go to TGEs, token generation events, and people still use that. But that's kind of moved away a little bit from that and moved more towards and I think that you're more likely to land on something around the world of STOs. For the simple, I don't think we're so easily going to get away from treating tokens as securities. And so that's simply what they are. But I do think that it requires an analysis of, and I do think we're going to get differentiating between security tokens, right? Because I have no problem talking about security tokens as being utility tokens, because to me, they can be both. There's absolutely no issue with that. But then there's also, I prefer the term, an equity token, when it actually refers to an equity token itself. But then you've also got a whole world of asset-backed tokens, which I view as different from equity-backed tokens, that are, things that are backed by art and cars and planes and, anything else that is a physical good, real estate. And those tokens should be treated differently. Notwithstanding that, I think the word, the STOs, the terminology, it's probably going to stick around, but it's important to understand that you really have all these different offerings underneath the STO.
Right. And the nomenclature that we're all using is changing. It's interesting. It changes every 6 months. So we'll see how that goes. So we have a question from Barry, which is interesting. He's saying, if the regulation A is being used for ICOs, will this result in the large investment firms or brokerage houses losing influence and power and revenue?
Yeah, and to me, I think that without a doubt, that's going to be the case. Now, to what extent, not clear, because at one point, what's going to happen is we're going to need some kind of protection that goes far enough. If you've got the entire world that turns into a private market where everybody is purchasing securities in the secondary market on alternative trading systems, I think you're going to get a lot of people that are going to get burned, notwithstanding the existing regulations. And so I kind of see there's still going to be a world for the institutional players, and you've already seen it happening. The world for institutional players is just going to be narrowing and narrowing more and more as people have control. And I think blockchain make that easier.
That's interesting. We are a modern financial firm. We're brand new, as you know. We're only a few years old, and we see ourselves as a modern financial firm, which is basically only embracing the Jobs Act. And we got lucky because the blockchain and cryptocurrency fell in our lap. We decided we wanted to move the ICOs out of the shadows into ICO 2.0. So that's our terminology for STO, is ICO 2.0. Everybody has a different way of looking at it in terms of terminology, but ultimately, at the end of the day, what Barry was asking for was a very simple thing: is, are they going to be disrupted? Are the Goldman Sachs, the Morgan Stanleys, who only cater to the very, very, very big, largest firms in the world, are they going to be disrupted? I was reading an article in the Wall Street Journal in the last few days that said that the number of public companies in the last 20 years have halved. And now we're under 5,000 public companies. And you have this index called the Wilshire 5000, which was very relevant when there were 15,000 companies. And now there's like 4,000 some. It's insane. And so what these large firms are doing, they're only catering to the very few, only taking a few hundred companies public. What if we, you and me, our industry together with the Jobs Act can help, 100,000 companies issue tokens and get traded on these alternative trading systems? What is that going to look like?
Yeah, and that's the interesting question. And I mean, you've already seen it. It's a small evolution, but you're seeing a few companies going public without underwriters through Reg A plus. So that's a small shift already. And I think the token offerings are just an acceleration of that in the way you described, where you've got 100,000 companies trading like that. It's really interesting.
Yeah, but those companies who are using Regulation A+, which allows companies to raise up to $50 million from the general public, are typically raising 10 to 30 million. The problem, once they become a reporting company and they list on the NASDAQ capital markets, for example, is that they have to now spend a lot of money per year just to be a reporting company, public company. That could be over $1 million. And again, if you raise 10 million, if you're going to have to spend $1 million a year to be in business, just to be public, it doesn't make any sense.
Yeah. I mean, the difficulty we have, right, we still have Section 12G of the Securities Act, right, which basically says that if you've got more than 500 unaccredited investors or 2,000 accredited investors and $10 million of assets, that you essentially become what's referred to as a smaller reporting company. And a smaller reporting company is still a reporting company, and there's quite a few obligations. So, it is interesting to see what effect that is going to have on the private token kind of market, because, unlike right now, you've got tons of private companies in the, Ubers, Airbnbs that are private, worth a ton. The second that you tokenize that, you could build in functionality to limit, having no more than 2,000 investors. Although, there is a question as to how hard that is with public wallet addresses being potentially owned by the same people or not. But in any event, you've got a mechanism where the second that you tokenize your equity, and your company, has more than $10 million of assets, you run into that potential for needing to become a smaller reporting company.
But isn't there a safe harbor if you are issuing it under regulation crowdfunding or regulation A+, that the safe harbor allows you, if you use a registered transfer agent like Startengine Secure, to have a $70 million limit?
Yep. That's exactly right. Right. The public float, you can have that public float up to, it's either 70 or $75 million. It's yet to see how equity tokens trade relative to what's been known as utility tokens on platforms. But if they have, they shouldn't. But I could see in the short term them having similar trading patterns, and a company that had raised $40-50 million could potentially find themselves relatively quickly at that higher threshold. In any event, I think people are going to get smarter about that and stop seeing equity tokens as just any other tokens, and start really realizing that their value should be reflected in the same way as any other equity token is, plus some kind of liquidity premium. And you're going to start getting normal valuations. But I think at initial trading, I think you're going to see some equity tokens going crazy, just because people say it's a token.
I understand that, but I think what this conversation reveals is they really need your help as an attorney to navigate these things, because a safe harbor is great if you know about it. If you don't, well, you're going to be into serious issues, right? So I think we're having a casual conversation here, but it really demonstrates the need of expertise, such as what you can provide as a experienced securities attorney. So I want to compliment you on everything you're doing for companies, because without these great attorneys, it just makes it even harder to be successful in business, because you at any point of time you can be running into rule infraction, and then we all know that that's even more expensive. Anyway, as we wrap up, Mark, anything else?
No, I mean, look, it's as you know, it's a two-way street. So having the platforms that make it possible to raise capital in a compliant way is important just as much. So it's always good to see Startengine continuing to innovate in that way.
Right. And we got some very clear guidance from the SEC not to use the word compliant or all of these words, because they say that would be misleading to the general public. So even us, we have to be very careful to make sure that our terminology is actually accurate. So we don't use the word listing, registration, when it has something to do outside of what the SEC's purview. I understand that. Anyway, as we wrap up, I want to thank Marc.Boiron for all of his great work in this industry, and also for participating in our program. You can reach Marc at his email address. We're going to post it here in the chat, but it's Marc.Boiron, which is B-O-I-R-O-N, at FisherBroyles. I know that's a complicated name. Maybe they could simplify it. But FisherBroyles is B-R-O-Y-L-E-S. But if you take a French name and you add some other names to it, it's even harder. Okay.
I don't think Facebook would enjoy us going with FB.com.
Yes, I understand that. If you owned it, you would actually be in a different business.
Right.
Anyway, all of this information is going to be in the YouTube, and we're going to pass it around. Again, thank you everybody for joining. We're very excited to be able to offer this to the marketplace. And I know I'm going to be speaking to Marc regularly, and I look forward to continuing my relationship with him and his firm. And thank you, everybody. And this ends our episode.